Good afternoon to everyone who's here and joined us for today's webinar. I'm just going to give it a couple of more minutes because I'm seeing a few people join in, and then we'll sort of kickstart today's discussion on multi-asset investing and the tax dimension of multi-asset investing. In the meantime, you can look at our YouTube channel. The QR code is here, so you can quickly scan uh, this QR code on your phone, and you should be able to see all of our content on YouTube. So just give me 2 more minutes, and let's be patient for the others who are waiting to join in, and we'll start off exactly at 12:05. All right. So today's webinar is going to be about multi-asset investing and the tax dimension. I think this is something that a lot of us think about when we're investors. That how much tax are we paying? Can we find some way to sort of productively reduce that? And in the interest of that topic, I think that's what the plan is for today. But more importantly, if you have any questions, please feel free to type it in the chat box or in the Q&A segment of your window, and we'll get to all of the questions towards the end. So I'll try to keep the presentation running for some time, and then we'll keep enough time for Q&A. And let's keep this as engaging and interactive as possible. So without further ado, let's begin. Right? So there's a very interesting and funny quote which says that there are only two certainties in life, death and taxes and death doesn't get worse every year. So in the run-up, I mean, I think the big event of February was honestly the budget. And it was quite a surprise, I think, for a lot of investors to see the tax benefits that have come in. Of course, there have not really been any changes to your capital gains tax rates, but your income slab rates have actually changed. And net, I think for anyone in the new regime, you're actually saving a lot more today. Specifically, if your income is over 24 lakhs in a year, then I think there's a net savings about 1 lakh that comes in regardless of how much you're earning, simply because of the change in the tax structure. So I think given that we've had a positive surprise, and also the current market context where you're seeing a lot more volatility, investors are looking at safer asset classes. So if we look at AMFI data that has come in, more money is actually moving into arbitrage funds in January, showing that there is some sort of expectation that you want to stay out of markets for some time. So there is obviously this need to look at different asset classes outside of something that's as volatile as equity is at the moment. And in that context, let's actually look at how we can think about what the investor's dilemma is today, right? Meaning, as investors, we want to save regularly. We don't really want to see too much downside, right? To the extent that we can avoid losses, we want to avoid that. At the same time, we're not very keen on compromising on returns, right? And the thing is, what investors really want to get right is to be at the right time, at the right place. And when it comes to multi-asset investing, what tends to happen is that investors tend to sort of um, investors tend to sort of uh, chase performance. So, meaning if we looked at gold as an asset class in 2024, there didn't seem too much interest in it, right? But if we look at gold today, literally every headline, every investor is talking about how gold prices have moved up quite a bit. So, this tendency to chase performance actually results in lower returns or lower compounding in the long run. So there's a need to get into certain asset classes before they become hot, before the performance arrives, which honestly means that you are going to deal with the early years of underperformance, but you'll have a good runway as well. So how are you going to find these ideas early on? How, like, what is the framework that we can sort of employ to make sure we're at the right place at the right time? Now, when it comes to making investment decisions on a portfolio level, I think there is this sense that you have to get the time correct, meaning you want to invest closer to the market bottom, or there's this sense that you need to make sure that you're in the right stock or right idea, right? So a lot of us put in energy into finding out which is the best time to invest. Like, are we at the market bottom? Is it going to correct more? Are we in the right idea in terms of, like, the final security, right? If it's a stock, did I buy the right stock? And so much of our time and energy goes into these two decisions, meaning whether we're getting in at the right time or whether we're getting into the right stock. But when we actually look at what explains differences in investor portfolio returns, the answer is quite surprising. And the answer is that asset allocation actually explains most of portfolio return variability, which is essentially that if you have two investors who've invested at the same time and they earn different returns, how do we explain that this person has earned a different return from somebody else? And the answer is that 90% of that return difference can be explained by what assets they choose to invest in, and maybe about 5% can be explained by what stocks they picked, and only about 2% can be explained by when they started or when they started their investments. So when we look at where our attention and focus is versus where it should be, there's this huge gap. A lot of us give weight and importance to picking the right stock and timing the market. Yet, what actually makes a difference is which assets that you're owning at any given point in time. So, our focus and energies actually need to shift from, trying to catch the bottom or trying to catch the stock at the right price to, are we in the right asset classes? Because asset classes can actually give us more stability and a more balanced approach to wealth creation. So this is one of our favorite charts as a team, which is why does asset allocation actually work? And asset allocation works simply because you have diversity, you have this idea of correlation, which means that at a certain macroeconomic context, certain asset classes will tend to do well. In a different part of the market cycle, different asset classes are going to do well. So when you have exposure to all of these things at the same time, then there is this advantage of having something that always performs, right? And something that always keeps your portfolio up. So when we look at, say, almost 13, 14-year data from 2010 to 2023, the things that you're going to notice are, if you just, this is a color-coded chart. There's nothing to really be intimidated about. It's not a scary chart. It's very easy to read. So if you look at whatever's on top, you can see the colors are constantly changing. And each color actually represents one asset class. So gold is in orange, you have your mid cap in blue, you have your international or global funds in purple, and you have small cap in gray, right? So if you look at the top row, what you notice is that this color of whatever stands out on top keeps changing every year, right? And if we just look at the first three rows as a chunk, you realize that over a 5-year period, right? On a 3-year basis, you'll see something in the top three, but on a 5-year basis, you don't really see the same things in the top three. Your shift happens every 3 to 5 years. And if we look at the bottom segment of this as well, you will notice that some things remain in the bottom for a while, but it's not forever, right? And so what we can learn from this chart, there are three important takeaways that we have, which is the first is there are no years where you lose money in all asset classes, right? So I'll shift back to the chart right after we look at the three lessons. And the second is that half of the time, all of your assets are actually delivering positive returns. And the third important lesson is that losers can become winners and winners can become losers as the cycle turns. So when we come back to this chart, just focus on the bottom row. Look at the number of years where the bottom row is positive. You should be able to count 7 years. This is a 14-year time period. So clearly, half the time, everything is a winner. And then if we look at the top row, you never have something which is a negative performer in the top half, right? Forget the top row, but in the top half of this chart itself, you don't really have any negative performers, which means that if you have a diversified approach, there's always going to be one engine that's firing for you. And at a minimum of say 10 to 12%, that's the expected return, even if you have one asset class. Now, this is why we need to look at our long-term compounding return closer to 12% rather than, 15 or 18 or 25%, which is the kind of returns that we've seen from 2020 to 2024. So it makes sense to moderate that return expectation and kind of look at a more balanced approach to creating wealth. So now moving on, right? Now I'm going to head into the section of the tax dimension, not asset allocation as such, because this is the core of today's webinar, where we're going to talk about how are each of these different asset classes actually taxed and how can they form a portion of your investment portfolio? What can you do about this? And when we get into this matter, we'll be able to understand what are the different approaches that there are there to investing in a multi-asset strategy. So first, we're going to look at whatever's been making headlines, which is your precious metal basket. So you have gold, silver, and there are many ways to actually invest in gold and silver. So you can have physical gold and silver. Now, ideally, you would not count jewelry as an investment, simply because there are a lot of making wastage charges that go into these things. At the same time, the probability of you selling jewelry is very low to generate cash, right? It is something that was used in previous generations, but now there's a lot of sentimental value attached to jewelry, and that's one of the reasons why you're not going to consider it as an investment asset. It's a use asset. It's something that we buy and tend to use. So if we look at gold and silver, you can buy bars, coins, and that's the physical format. So for this asset to become long-term, from a tax perspective, you need to hold it for 2 years. And if you sell it within 2 years, then you're going to pay tax at your slab rate. Similarly, if you look at mutual funds, I think the question that has come in is, I think mutual funds are 2 years and ETFs are 1 year. That's the difference. Because in mutual fund, the taxation is equity and non-equity, and precious metal funds get categorized under non-equity. So here again, your short-term tax rate is at your slab, and your longer-term tax rate is at 12.5%. So if we move to ETFs or sovereign gold bonds, now, sorry, let me cover ETFs, because ETFs, again, your short-term is 1 year and your long-term is beyond that. So your slab rate at short-term and 12.5 at long-term. Now, the last asset is something that, again, so if we look at when investor interest sort of peaked or picked up in sovereign gold bond schemes, it actually happened in the last 6 to 10 months. That's when a lot of investors have been coming and asking whether they can buy in the secondary market. And there wasn't too much of an interest in participating prior to that, even though this was a fantastic investment, right? So sovereign gold bonds are issued by the RBI, and it has essentially government backing. And more important, pay out a certain interest. So this is the only form of gold investment that was giving you a cash flow, right? So if you own an ETF, a mutual fund, or even physical gold, there's no cash being generated from this. So this is what made the sovereign gold bond scheme very unique. This interest, of course, was going to be taxed at your slab rate. But if you held the sovereign gold bond until maturity, you would not pay any capital gains on the SGBs. But if you held it beyond a year and you traded in and traded out, you would pay long-term capital gains of 12.5%. So clearly, this has been sort of a winning investment. There are no more sovereign gold bond schemes which are being issued, primarily because it is a heavier tax on the government. They are paying for you to own this. So from their perspective, it doesn't make sense to issue more sovereign gold bonds. And I think the intent behind not having capital gains was that when you have a 7-year investment horizon, then it's very difficult to predict what gold prices would be at the end of that. And the idea was to protect investors from any capital loss that came in case gold prices corrected over that time period. So now we're going to look at real estate as an asset class. And here I've also clubbed in infrastructure investment trusts, even though they're not technically a real estate asset class, simply because it'll be a little bit easier to sort of look at them alongside REITs. So in InvITs and real estate investment trust, that is your REITs, for them to become long-term, you need a 12-month horizon. And if your short-term capital gains are going to be at 20% and your long-term capital gains are going to be at 12.5%. So in last year's budget, what happened was there was a revision to your real estate taxation. So you lowered your time period from 36 months to 24 months, which meant that now all assets are pretty much long-term by a 2-year horizon. Your short-term would be at slab rate and your long-term would be either 20% with indexation or 12.5%. Right? So moving on to our next asset class, which is essentially stocks. So here, I think this might clarify the question that came into the chat. So if you own stocks, then your short-term timeline, your long-term timeline is 12 months. Your short-term capital gains is at 15% and your long-term capital gains is at 12.5%. If you own mutual funds where the average holding of equity through the year is more than 65%, then it gets classified as similar to stocks, meaning 1 year is your timeline for long-term capital gains, and you pay 15% in the short term and you pay 12.5% in the long term. But if you are owning some kind of hybrid mutual fund, and on the hybrid mutual funds, you are looking at anywhere between 40 to 60% equity allocation, then your holding period actually goes to 24 months, right? So you're now at a 2-year long-term horizon, and your capital gains in the short term is going to be on your slab, and in the long term, again, is 12.5%. So the big change that came in last year's budget was this kind of rationalization. So pretty much all long-term capital gains are going to stand, except for debt funds, are going to stand at 12.5%. The timeline only varies between 1 and 2 years. Which brings us to our last category in terms of debt mutual funds. So here, if you have fixed income as an asset class, then if the bonds are listed, right? So there are many instruments here. You have bonds, you have mutual funds, and you have ETFs. So if we look at listed bonds, then the taxation is very similar to equities. So 1 year is your long-term horizon. You pay 15% in the short term and 12.5% in the long term. If you're looking at unlisted bonds, then your timeline increases to 2 years and you pay slab rate. Similarly, if you're looking at debt mutual funds, there is no long-term timeline and you're paying slab rate in both cases. If you're looking at conservative hybrid funds, right? So you might have a multi-asset fund or something in the conservative category itself, where the debt allocation is more than 35-40%. In that case, 30%, then in that case, your timeline is actually 24 months and you pay slab rate in the short term and you pay long term. So any mutual fund where you have allocation to global, you have allocation to debt, and all of this crosses that threshold, then there you're going to actually have to wait for 2 years. Which brings us to, okay, now that we've talked about all of these different asset classes and how they're taxed, how do we actually do multi-asset investing? We've built a strong case for why you should do it, because this is what is going to explain why somebody has better returns over another investor. But how do we get to this process of multi-asset investing? And I think there are broadly 4 game plans, where the first is that, okay, I'm sure I can do all of this by myself. Like, why would I need another professional to sort of come into the picture and help me with these decisions? I have my bank FDs that I'm very happy about. I bought some gold on the side. I've got some stocks that I'm managing, and I run my SIPs in mutual funds. So given all of this, I think I can more or less take care of my overall asset allocation. And this strategy works for somebody who has a very hands-on approach to managing their finances. So someone who's well tuned to what's happening in the market, who actually has the time to dedicate and look at things and to also report everything into one place. Because what tends to happen when we don't do this high level picture and taking a bird's eye view of our assets is that we tend to have misallocations, right? You might have bought a little bit of gold, or you might have bought a little bit of, you might have some money in FDs, but you really don't know how much it is as part of your overall portfolio. And you don't know whether it's at the right level or not. For us to be able to do these things, we need to have that visibility into how the portfolio works, and we need to be able to see the larger picture. We can't just be looking at individual decisions and being comfortable with our allocation based on that. Then, of course, for someone who is an investor, you could look at either, say, option 2 or option 4, where you're looking at hiring a portfolio manager so that you can participate in a multi-asset portfolio management service, or you might look at a mutual fund where you can just hand your money over and the fund manager sort of makes these decisions. In both of these cases, there is this ability to sort of hand over this process to someone else and to stay away from making those decisions and being able to see your holdings in one place. And then, of course, the third category, of course, is that there are people who question why they would need asset allocation at all. And this might come from somebody who is in a younger age group where they feel that they need to be more aggressive or that only equity is going to work for them. And the response to this is, on a case-to-case basis, you need to actually see what works for you, right? You might be an aggressive investor, or you might think that you're an aggressive investor, but we have this tendency to misjudge our own risk appetites. In a very positive market, we've seen many conservative investors take higher levels of risk because performance has given them confidence. But when the market tide turns around, they find themselves caught on the wrong side of that tide, and then they realize that, okay, this is not actually my risk appetite. I cannot handle a 15-20% drawdown. It's quite difficult for me to process and digest this. Similarly, sometimes you might underestimate how much risk you need to take to actually achieve your goals, right? So if you're a very conservative investor, you might not want to move out of the safer investments that you participated in, but your goals might be ambitious and you might actually have to compound at a much higher rate. So there is a need to look at asset allocation, one from your perspective in terms of how much risk you're comfortable taking, but two, also from the perspective of what you want to achieve with your wealth. And beyond this, asset allocation is what helps us tide through volatility, right? And volatility makes us change our behavior, which is a most important lesson. We tend to change how we make decisions because we're afraid of what's happening in the market, or we're not afraid of what's happening in the market. So the fine balance here is to actually be able to look at asset allocation as a solution against these waves that come and go in the market, right? Asset allocation helps us stay on course when things don't go according to plan. So everybody needs some level of asset allocation. If you're a younger and more aggressive investor, then maybe the two assets that are really going to work for you are cash and stocks. If you're an older if you're an older investor, then maybe the two assets that are going to work for you are fixed income and stocks. But there's no harm in having other assets in the portfolio, especially those that have lower correlations with these asset classes. Could help you boost your returns and get you returns from a different source, right? So now I'll talk about what is the advantage of looking at a product like Sphere. Specifically, I think the question that would come to mind is like, okay, if I could invest in a good multi-asset fund in the direct plan, then why would I need to actually look at a portfolio management service? Because there is a certain inherent tax advantage that's there, because I don't have to pay capital gains every time the fund manager changes something in the portfolio. At the same time, I'm a long-term investor. I have a flat fee. It's probably lower than the fund management fee. So let's look at what Sphere does differently from its peers. So I think the first thing that we need to understand is that our strategy is forward-looking. And this means that we are not chasing performance. And you can see this from the way that we've allocated our portfolios. We are not really looking at past data. We're looking at what could be drivers of future growth. And this means that we have a slightly more contrarian nature to the portfolio, which you may not get within the mutual fund space, primarily because there is a need to stick to certain benchmarks. There is a need to fund, to have your asset liability balance out in terms of funding redemptions. And we also have a very strong value focus, right? So when we're looking at things from a valuation perspective, we have to buy things when they're undervalued or fairly valued and wait out for longer periods of time. So there is a longer holding period. And this actually lines up quite well with our tax conscious way of investing. And what do we mean by this? We understand that every churn or every transaction is going to incur a tax liability for an investor. So what we try to do is we try to keep everything long term. We try to look at things that have a longer thesis and a longer investment horizon, and that helps us reduce the tax liability at the account level. Now, speaking of the account level, I think one thing that we need to talk about is customization. So when you're going through a mutual fund route, what tends to happen is there's a preset portfolio for the fund, and any additional contribution that an investor makes goes into that preset portfolio, right? When it comes to a product like Sphere, what happens is that every time you contribute to your portfolio, there is a certain level of customization that happens. Because when you contribute on a day-to-day basis, opportunities in the markets can change. And on a longer time period, there might be new ideas that enter into the portfolio. There might be ideas that exit out of the portfolio. But clearly, there's no churn that is being done to participate in new ideas, right? The new idea comes from your additional contribution. So as and when you participate more in this product, you are going to have a more customized portfolio, which is reflective of opportunities that were available in the market at a given point in time. And that leads us to, okay, how are these portfolios actually constructed, right? So there's a lot of focus on being value conscious. There's a lot of focus on getting the positions right. And so that is sizing, right? So when you look at a mutual fund portfolio, you will have a long tail. But when we look at a product like Sphere, we have a very concentrated universe. We have investors who are able to participate in few good ideas. So there's a long filtration process that goes before an idea comes into the portfolio. And it's a very concentrated and focused approach to create wealth. And the other big key advantage is that you actually have true investment flexibility in a product like this, because the mandate allows us to go from 0 to 100 in any asset class. Whereas if you're looking at mutual funds, usually there is an asset class level restriction, meaning let's say you take a product like a multi-asset fund, there should be a minimum of 3 asset classes and a minimum of 10% in each of these 3 asset classes. If you take hybrid funds, depending on whether it's conservative, aggressive, there will be a cap on how much equity, how much debt should be there in the portfolio. So given all of these constraints, I think one thing that is clear is that this product gives you a lot more flexibility. It gives you a lot more flavor of different asset classes. So we have precious metals, we have global, we have fixed income, we have equities. All of these are part of your portfolio. So if we look at drawdown as well, our largest drawdown happened very early on. And our drawdown is anywhere between what happened in the multi-asset index versus the Nifty. So we are a more equity-heavy product. So clearly, like our drawdown would be higher, but we tend to fall less than a pure equity index like the Nifty as well. And before we open up for questions, I would like to sort of showcase our performance for the last month. So as of Jan 31st, our 1 month returns were about 1.4%. Our 3 month, whereas the index fell by about 1%. On a 3 month basis, we have underperformed against the index. So that's been a -4% against a -1.5%. But if we look beyond that, right? So if we look at 6 months, 1 year, 2 years, 3 years, or even our since inception returns, then we have outperformed the index by a nice wide margin. If we look at the construct of the portfolio today, about 65% is in equity, and this has been trimmed down consistently through 2024. We have a reasonable allocation to precious metals. We have a good allocation towards global ideas, and we have some level of cash as well as fixed income in the portfolio. So there's been this gradual shift. If we look at this data from, say, a year ago, then we would have seen we had a much more equity-heavy portfolio, and that shift has happened gradually month on month. And this allows us, this kind of process of moving from one asset class to another takes time, and it will show up in our performance data as well. So a quick look at the terms of investment. We are a SEBI registered PMS, which means that there is a minimum investment of 50 lakhs. Our benchmark is NSE's Multi-Asset Index 1. So that has an allocation of 50% towards equities, 40% towards arbitrage, and 10% towards REITs and index. There is no exit load on this product, which essentially means that you can enter and exit at any point. But we do recommend that you keep an investment horizon of 5 to 7 years, simply because that's when you get a good flavor of multi-asset investing and you're able to participate through a market cycle. We have a very simple fee structure, which is 1.5% per annum, and it's computed on the daily average AUM. It excludes any GST or expenses that you might have. But even keeping all of that in mind, it's not a very expensive product. It's competitive if you look at, say, multi-asset product as well. And then I had already explained about the asset allocation and how much flexibility there is in terms of moving from one asset class to another. And our mandate is to not have any exposure to a single asset class beyond 25%. So there's a huge team at office that's working towards our portfolio management services. We have 4 products in the ecosystem. So we have Solitaire, which is our flagship product. It's a multi cap strategy. We have True Blue, which is our blue chip fund. We have Vriddhi, which is a small and mid cap PMS, and we have Sphere and Neo, which are multi asset PMSs for residents and non-residents, respectively. We have a great team that's working behind the scenes to make sure that everything goes smoothly for investors. And with that, I will open up for Q&A. So if there are any questions, I'm happy to sort of take them. I think there's one comment in the chat which I have already answered. So I'll just wait for some Q&A to come in. In the meantime, if you want to do a one-on-one conversation, then I will just put up our numbers here. You can quickly drop a message to 9500027285, and we'll be very happy to answer any questions that you have about our portfolio management scheme, or if you want to know more about Sphere or anything else that iThought does, then please feel free to sort of just quickly type a message on WhatsApp and our team will get in touch with you. Okay, great question. Let me also just quickly explain what the M2W program is for the benefit of everyone on this call. So we're running a program called Milestones to Wealth, which essentially helps an investor to grow from wherever they are in their wealth creation journey to their first crore in savings. And this is a program where we handhold investors and help them choose the right products and funds, make sure on an overall financial level, your financial health is in a great place. And there are a lot of education initiatives also that happen. So if you want to learn more about markets, if you want to learn more about what's happening at a given point, then we constantly run webinars. And we have a very active presence on YouTube as well. So in M2W, primarily the investments is through mutual funds, and we are asking about how we can execute a multi-asset strategy there. So as an M2W investor, you would already have a multi-asset strategy within your portfolio. So one of the key focuses for 2024 was to get in the precious metal allocations there. So as and when you would have contributed, I think you would have received a lot of messages from our team on opportunities, whether it was on the multi-asset side, whether it was on that is on the precious metal side, whether it's in fixed income. So now you see a lot more on arbitrage, fixed income, those kind of calls that are coming in. You would have also gotten certain sectoral calls in terms of, say, how what we found positive in 2024. So this is how you can do it. And it is very much an integral part of the M2W program to give you a holistic, well-rounded portfolio. So I hope that answers your question. And I look forward to anything else that you might have to ask. Okay, moving on to our next question. Is there any advantage in ETF funds over folio held with mutual funds from taxation point of view? So I think we need to understand there are many things, right? So ETF is more a passive strategy, whereas MF is a more active strategy, depending on what kind of products you're looking at within both spaces. From a taxation point of view, when you're looking at debt, it's the same, whether you do an ETF or an MF. Your cost might be lower in an ETF, so that might be a consideration. But again, you have to think about whether you want a passive strategy or an active strategy, because debt ETFs, there are not too many, and most of the ones that are there are only target maturity, that is roll down kind of strategies. So you have to see whether that is what you want to participate in, because if you want a more active role, then I think you should be considering mutual funds. But from a tax perspective, I think the key difference is only in the precious metals basket. So there is a timeline of 1 versus 2 years if you're choosing the ETF, which is a listed security, versus a mutual fund, which is a unlisted security. So that would be the key difference. But if you've already held your mutual funds for a while, then I think it's okay. And more importantly, like if you're an investor and you want to have some level of hedging, it's okay to buy it in the mutual fund route also. Yeah, I think we've just started seeing the price move, right? So that is something that you can expect. But more importantly, I think we need to understand with every asset there are three phases, meaning there is a buying phase, there is a holding phase, and there is a selling phase. So when you move from one to another, it's basically performance oriented, right? So we have to think about it from that perspective. Because entry valuations matter a lot. So depending on what price you buy, you have that much valuation comfort. Given volatility in the market, should we prioritize allocating to lump sum rather than stepping up the existing SIP? So this is a very good question. I'm happy that it's come up in this webinar because the basic idea here is that you have to choose how you're going to scale up your investments, and there is a need to scale up your investments every single year. So given that, if you're seeing volatility in the market, you will get a lot more lump sum opportunities this year. For this year alone, you can sort of deprioritize your step up SIP and participate through the lump sum route. But that being said, I think it's very important for you to know your own behavior as an investor before taking that call. If you're a very disciplined investor, then you can take that call and reduce your step up or stop your step up and instead do lump sum investments. But if you're the kind of investor who's going to worry about what's happening in the market, there's a very high risk that you will neither do the step up nor will you do the lump sum, because we have seen this happen, right? With investors where when the markets behave very irrationally, they are unable to sort of process and participate at that point. So I would suggest that after some reflection and after understanding what kind of investor you are and how much discipline you can maintain, one thing is to definitely have this conversation with your whoever is guiding you in the M2W program, because telling them that, okay, this is the decision that I have made, they can help you participate at the right times in the markets. If you unilaterally sort of decide that you will not do step up this year, then their ability to sort of guide you through the lump sum opportunities will also be limited, because they might not know how much liquidity you have, they might not know what your savings target is. So before you make the decision of switching from step up SIP to lump sum, I would suggest first keep a savings target for 2025. So what is the normal savings that you would have done? What is the step up savings that you would have done? Versus what is the stretch savings? That is, if you plan to save 1 lakh every year, then now over and above that 1 lakh, how much can you stretch and save? Can you do 1 lakh 10,000? Then that should be the target for the year. Then on a monthly basis, you examine how much you've contributed to your portfolio. You try to fill that gap month on month. So we're already 1.5 months into this year. So we should have that clarity as to how to do it and make sure that we're following that process and making sure that we're saving this year. So this is actually a year to save more, right? This is not a year to expect better returns from your portfolio. And that mindset shift has to happen as early as possible. For buying the stock, there are many portals for advice, but not so much for selling a stock. My advice: work with an advisor. I think that would be the best advice, because your insight is absolutely spot on, right? Many people will talk about what to buy, will give you this full thesis on buying a stock, but when it comes to selling, there is actually nobody who's talking about it. And it's very buyer beware in that context. So I think the basic idea is that you should actually have a process for selling. If you don't have a process for selling, then have an advisor. If you don't have an advisor, then work with a portfolio management service. Let someone else take care of the buy and sell decisions. If you don't have the ticket size for portfolio management service, then look at some good mutual funds, because there you're getting the same stocks. You're paying, of course, you're paying a fund management fee. But if you think about how much you can lose from not selling a stock at the right time versus how much you're paying a fund manager to do this job for you, I think the math is very clear as to how it's benefiting. We still have about 10 to 15 minutes on the webinar. So if there are any more questions, I welcome you to type them in the chat box or in the Q&A segment, and we can take those questions. Okay, so not related to this presentation, but came across some MLD products with 90% in bonds and balance in equity that offer downside protection in a 3-year period and minimum 6% return. So, see, if the minimum return on a 3-year period is 6%, and you're taking equity risk, right, of 10%, why not just look at an FD? Today, your FD is anyway going to give you more than 6%. You at the same time, the taxation is pretty much the same on M&As as well as your deposits. So why take that risk? Your prognosis for dollar versus INR for 2025. I don't have an answer to this question, sir. It's a good one. Currency is actually the hardest thing to predict. I think to a certain extent, you can even look at valuations. There are some pointers when it comes to markets, but currency is, there are too many variables, right? Meaning trade, and today trade is such a unknown variable because you have Trump in the picture. There are a lot of talks around tariffs. You don't know what direction that is moving in. That affects your currency. At the same time, interest rates affect your currency. At the same time, you have intervention that's coming in from central banks. You could see policy from the US if they want to increase global trade, that is trading with extra, supplying to the world, then they have to look at some level of um, depreciation for the dollar. At the same time, dollar has been one of the strongest currencies in the last few years. So it's very, very difficult to predict this relationship. You can have a framework in terms of, what are the macro parameters that you're tracking. Definitely trade should be one of that, interest rates, policies, whether the US is going to devalue the dollar or not. Those are all things that we can keep in mind. And at the same time, I don't think you should have a direction. If you're worried, that is like if you have goals that are in different currencies, sometimes we might be saving to educate our children abroad. In that context, then hedge it with some dollar investments as well. We anyway have that benefit of doing $250,000 through the LRS scheme, and you can have some assets abroad that can help you manage this risk better. Okay. From a tax perspective, investing for minor kids in their name works better than investing in our name. This is planned for the kids' university and time horizon is 10 years. Great question. I think simple answer. If it's a minor, the income tax is clubbed with the parents' tax. So I don't really think there is any tax advantage as such. Um, you can, if let's say one parent is not working and they have a lower tax income, I mean a lower income tax slab, then maybe there might be some benefit there. But from my understanding, if there's only one earner, then it is understood that that will be the tax slab. So the key advantage is in segmenting the assets. That is, if you're running an SIP on their 18th birthday or 20th birthday, you want to give them some assets. That portfolio can be fully assigned to them when they become a major, right? So I think that is the advantage. But from a tax perspective, I don't really see any benefits in doing it separately. It makes more sense from a planning perspective. So I still have time for one or two more questions, and then I'll take the next two questions, maybe or two or three questions, and we can stop. But before that, I would like to thank everyone for coming in today. I would also like to thank everyone for asking such interesting questions and helping everyone learn on this Saturday. The webinars are essentially a Learning Saturday initiative. So it gives us the opportunity not just to learn from the speaker, but from the questions that come in. And you've all been really great. And we would like to see you at our next webinar. Any minimum tax exemption for short-term and long-term capital gains? I think short-term, there are no exemptions. Long-term, I think the first 1 lakh for equity alone is not taxed. Other asset classes, there are no exceptions. So if you'd like to know more about I Thought PMS, what we do, or Milestones to Wealth, where we help investors through the mutual fund route, then just quickly drop us a message on 9500027285. The number is on your screen, and you can always reach out to us and we'll get back to you. We love working with investors, we love helping them learn more about markets and creating wealth. So I think this is something that you can easily and quickly do. Okay, so let's take this. With changing strategies always with SIPs, do you consider the taxation aspect before making any switch or redemption? Of course, I think, like I said a little bit earlier as well, like when you have any investment that you're doing, right, there is a buying phase, there is a holding phase, and there is an exit phase. So ideally, if we come with a long-term view, there will be a decent amount of time in the holding phase, which means that you don't want to invest right until the end of that or rally. You want to actually pause when valuations get outside that comfort zone. So that pause actually helps you become more tax efficient. So that is definitely a point of consideration before we sort of. So you might be running an SIP for 2 or 3 years. You might be holding that portfolio for another 1 year or so, and then you might exit, right? So that there is that pause that helps you become more tax efficient with the last few SIP units. That being said, if somebody comes in a little bit later into the journey, then probably their holding period might be less, and they might actually end up having some short-term capital gains that occur. Alternatively, if the holding period can also contract if the market very quickly starts rewarding that theme, right? So you can suddenly see a big run up, in which case, if you have short term units to de risk, you definitely have to. But that would also mean that you have earned a very high return in a very short span of time. All right. So this will be the last question that we take. I don't think we have any questions from YouTube either. All right. Thank you, sir, for those warm words. Thank you, everyone, for participating today. And with that, we can close today's webinar. If you have any questions, or if you're looking for an advisor or a portfolio manager, or just some help on the mutual fund side, you can always drop in a message, and we can start working with you in whatever capacity you need. So thank you once again, and talk to you soon.